make sure we are recording. Thank you. I love my friends and my team who's helping me. Thank you. Shout out to Elizabeth and Supreet. Thank you so much. So yeah, Lydia, would you take a moment and introduce yourself and just share your background so folks know how amazing and badass you are in this tax world?
Oh, thank you. Keep going. Keep going. No, kidding. So, yes, thank you so much for having me. Lydia Desnoyers. I am the founder and owner of DesCPA Business Advisory, and we specialize in helping businesses grow and become more profitable. In a nutshell. And obviously, as a CPA, do taxes as well, high net worth individuals, and complex scenarios, complex involved scenarios, I would say. And I've been in business for over 11 years now. And I'm really excited about this conversation because I think it is the way of the future, and it's important to know, the implications of things that we're going to be using every day. And further to what Michelle said, that this is for educational purposes. At the end, the last slide, we have my contact information as well as Michelle's, but in my contact information, if you have any specific questions that perhaps are not addressed here, cannot be addressed here for respect of your privacy, or perhaps it's beyond the scope of the conversation we're having today. So don't feel that, if your question hasn't been addressed here, that it cannot be addressed. I'll definitely be available. But as Michelle said, this is for educational purposes. You should consult with your tax practitioner or preparer. And again, I'm available to help if you have anything more specific. And then the other thing I would say to kind of set the tone, an underlying but very, very important point I want to make is that the IRS has not really provided that much legislation around crypto just yet. So, that's still a work in progress. Things may change. There are new bills being presented, as recently as last week around crypto and things like that. So it is something that's probably going to be addressed not just this one time, but on an ongoing basis. And whatever we discuss today may very well change in a few months or for the next tax year. So I just want to make sure I, convey that at the beginning so that we know. But what we're going to talk about today is based on the general rules as they stand right now, some guidance, which is different from actual law, but some guidance that the IRS has provided around virtual currencies, since it is becoming more and more prevalent in our everyday lives. So that said, let's get to it.
Let's do it. All right. So first things first, I bought crypto. Lydia, I bought more crypto last year than I have, and I bought various types of crypto. I did it on a couple different exchanges. I used different apps. So if I bought crypto, what are the things I should be thinking about and preparing?
Awesome. So I know, on social media, all your friends and stuff are posting how much money they made on crypto. So all of us not knowing anything about crypto are just like, let me go and buy ETH or Shibu or Dogecoin, because of what's his name, Elon Musk, who tweeted about it, right? Without really knowing exactly what's going on. So generally speaking, the guidance that IRS has provided is that crypto or, these virtual currencies and virtual assets and stuff are treated like property or capital assets. So think of if you ever dabbled in investments like stock and stuff, that's how we're going to think about crypto. And so generally speaking, when you buy stock or buy property, buy crypto, there is actually no taxable event at that point. So it's like any other purchase, you're just buying the crypto and there's no tax implication to buying it. That said, you still want to keep record of that purchase. You want to keep track of the date that you purchased it, how much you paid for it in US dollars, and the unit, the quantity that you bought of that virtual currency. And so you want to track that information, even though it's not actually taxable at the time that you purchase it. So let's go. Now, what else? When you buy
I'm
it, what do
taking
you
notes.
do with it?
So you guys, like, you guys think I literally, this is the call I needed to have with Lydia. So I'm typing my notes in the response in the chat. So I'm like, these are my notes of things I need to make sure that I'm keeping track of. And, I think when you compare it to buying stocks, I'll be honest, I rely a lot on, let's say I'm buying stocks on Robinhood. At the end of the year, I get a form, right? That basically does all the work for me. It tells me when I bought, how much I bought. But this is a little different, right? Because when I bought some cryptocurrency, it's harder, I think, to attach the, dollar amount, because is it registering what the value is today on the day I'm pulling report versus, the moment when I bought it. And so this does really necessitate us being more in the driver's seat, which honestly is a theme of Web3 and decentralization overall, right? Self-sovereignty, like it's more on you to keep track of these things. And so I think that's why it's so important to get this advice now.
And you make a really good point comparing to stock, right? Because stock is regulated, right? And so these platforms which you buy stock, whether it's through a financial firm like, Edward Jones or one of those, they do provide you with reporting at the end. Believe it or not, there was a period in time where there were no reports. You were responsible for tracking that stuff yourself. But then, of course, IRS started to provide regulations and guidance and actual law that said, okay, you, Edward Jones or JP Morgan or any of these houses have to provide a report to the taxpayer as well as report it to the IRS, right? So now crypto coming up, or virtual currency coming up very, very recently. Well, actually it's been around for a while, but it's just becoming so much more accepted and available to the everyday person. That said, the whole idea behind crypto and virtual currency was so that it's not regulated, right? So that it's this unregulated environment. And so there was no way to really track things. But then, of course, Uncle Sam got wind of people, making so much money off of it. And now they're like, wait a minute, I want my cut. And that's how Uncle Sam works, right? I mean, they want their cut. They don't care how you make the money, they want their cut. In fact, even if you're involved in illegal activities, they want their cut of that income. So what we're going to start to see is if some of you may have noticed in the past couple of years that there is a little question on your tax return that says, did you transact or exchange virtual currency? And that was the extent of it, right? And so that showed you now the IRS is taking this seriously, and there's going to be a little bit more regulation and requirements and reporting requirements. And so the next phase that we see now is that more and more of these platforms are now actually providing these tax forms and these records to help you with preparing your tax return. So I see some of the comments are talking about that, so we'll talk about that. But okay, so now you bought cryptocurrency, and what are you doing with cryptocurrency, right? Now, there's two things you could have done with cryptocurrency. You could be just for speculation, like speculatory, like investing. So you bought it, waiting for it to increase in value as an investment, right? Or you may buy it to actually transact, right? And so what we're seeing now is that there are a lot of companies out there that are beginning to accept cryptocurrency as a form of payment, okay? And it's really important to know that. So for example, Tesla accepts cryptocurrency as a form of payment. I remember seeing a headline the other day that now banks are beginning to invest in cryptocurrency, and it's showing up on the balance sheets of some big financial institutions. And so it's becoming now used, or actually what it was originally intended for was for purchasing on the black market. Again, remember, it was intended to be
the origin story. That's right.
Yeah, it was meant to be in this unregulated environment, right? For shady stuff that people didn't want the government to know about, right? So now
we have since matured, yes.
Right. We have since matured. Now we want to do the right thing. But yeah, so now it's so then it became when it became widespread, it became an investment opportunity, and now it's coming back to in a mainstream being able to use it for purchasing. And so when you buy something with crypto, there's you have to kind of look at it as two different scenarios, right? So now when you're buying with crypto, it depends on the timing and the change in the value of the crypto at the time that you make the purchase, right? And so if you bought crypto, I'm going to keep the numbers very, very simple. You bought, let's say, I'm just going to say 2 units of ETH for, let's say, $1, right? And then it increases, the value increases to $2, right? So there's a spread there. Now you buy something with that crypto that's worth the $2, right? Because that's the value of it now. There's a gain there, right? So that's the first transaction, is now you dispose of the crypto and there's a gain there. Now what you're actually purchasing, there's no tax implication there for you as a person making the purchase. Now the person receiving it, let's say you're on the opposite end of this transaction, you're the one being paid with crypto, right? Whether it be in your trade or business, if it's somebody reimbursing you for something, that's a whole separate conversation. But in the trade of your business, you're being paid for a service or product that you provide. So Tesla, for example, they get paid in crypto. Now they have to report that crypto as income based on the fair market value of the crypto at that time. So we're using the example of it was valued at $2, right? And let's say you buy a Tesla for $2. There's a joke. But you buy a Tesla for $2.
I know, I love these numbers. I would love to buy ETH at $1. Yes,
right,
I love
exactly.
This is
I just want to keep it
You're
simple.
right. We got to use round numbers.
Yeah, I got easy small numbers, right?
Yeah.
So it doesn't. so Tesla would report $2 of income, right? At their ordinary tax rate, whatever the tax rate is, and you would pay capital gains taxes on that difference between what you bought the crypto and at the time that you exchanged the crypto. So again, keeping track of those transactions is really important. What was the value of which you disposed the crypto?
Fascinating. Okay, yeah, it's a lot of work. We need to make sure that we are really in the driver's seat of this, right? And making sure that we have a sense of pricing when we purchase, pricing on date of exchange, or purchase of something else. I also wish I was buying a Tesla for $1. I love
$2. Hold on.
$2. That's right.
$2.
That's right. It went up to $2. So this is something I think that's happening a lot, and I know I have done a lot of this, of exchanging my cryptos between each other, right? So I I bought some Sandbox. Actually, this happened today. Sandbox, a metaverse, and so bought some sand currency and then wanted to exchange that to ETH. So let's talk through what the tax implications of that exchange that are.
Yeah. Okay. So I'll be honest. I think I mentioned to you, Michelle, that up until like last week, I didn't even know you can exchange virtual currency like that. And I have a Coinbase account, and I remember seeing the option to convert, right? They call it converting, same thing, exchanging one currency for the other. And so where in Coinbase, it seemed like a one step, right? I hit convert, I say how many, and then, how much I want to convert, and hit submit, and then it does the work for me. But what's happening in the back end is it's actually 2 separate transactions, right? Or multiple transactions, I would say. So the first thing is the currency that you are giving up, right? Remember at the beginning, we said when you buy currency, generally speaking, there's no taxable event, right? It's when you dispose of the currency, whether you sell it, give it away, exchange it, that's what creates a taxable event. And so in this case,
because the currency is literally property in this essence,
correct,
right?
Exactly. It's treated like property. Think of, again, stock, right? You buy stock. I think that's the easiest way. I think a lot of us are used to that now, hopefully by now. So the currency that you're giving up, again, you have to remember how much you bought it for, when you bought it for, and then what was the value when you disposed of it. Did it go up or did it go down? Because that would determine whether you had a gain or whether you had a loss, right? And then the next part of that transaction is that you're buying.
Wait,
right?
really quick, just to verify. So step 1 is essentially calculating the capital gains on the currency I'm giving up, right?
Of the currency you're giving up.
Okay, great.
You're such a great student. Are you the one that sat in front of the classroom?
I'm actually a really good student when I'm not distracted on my phone and on 7 other apps. Like I can listen and
Right,
be in. I'm taking notes. I'm good. All right.
I'm sure some professors looking at you right now like, yes, that's my girl. So yes, exactly. That's a perfect way to sum it up. And so the second part is the crypto or the currency that you are now acquiring, right? And so that is, remember we said at the beginning that when you buy it, it's not a taxable event. So now you just have to track how much of them did you buy, at what value at the time, and the date. And you keep that until you dispose of that new currency later on. So is just to think that it is two separate transactions. There's a disposition of one and there's the acquisition of the next.
Great. So the second part is similar to what we were talking about before. So it's really just keeping that record, right?
Exactly.
But that moment, that's a purchase of a new property and not taxable event.
Correct.
Okay.
I like to say, generally speaking,
right,
as a
right.
CPA, we never speak in absolute,
okay.
yes, we never speak in absolute terms because there's always that exception and then the exception to the exception. So generally speaking.
Yep. Okay, great. So now, and I see a lot of folks in the chat thinking about this part. So if you bought or created an NFT, so now we're using our currency to create some sort of, or, buy some sort of digital asset. I am on the edge of my seat for this one.
Okay, so Michelle, I'm sure if you're okay with me sharing, when Michelle was kind of showing me like the NFT, and we said this is conversation. I use a lot of profanity in my regular conversation, so just deal with it. But I remember thinking to myself, what the fuck is this? I was like, is this a video game?
I was toggling, for folks who are listening, I was toggling between, I was showing her a couple of NFTs I bought. One is Creeps. I don't know if anyone has seen the Creeps, which is actually a video game play to earn thing. And it does, it looks like a children's game. And Lydia was like, what? Like, what is this? Like, we have really entered into, you can't even call it the Matrix, because it's like, it's less professional and formal than that.
Right. It's like the metaverse, right? I'm just like, oh my God. And it was so funny is that my nephew's birthday, he just turned 10 a few days ago. And I asked what he wanted. And it was like, I want Roblox or whatever. And I was like, oh my God, that's an NFT. I was like, my nephew is buying NFTs. And so it was just so mind blowing to me. Right. But
parents are lucky that they don't have to do tax returns on their kids, because man, like there's a lot of transactions happening in Roblox. That's another webinar.
Exactly. That's a whole webinar. And it's like, part of me is like, okay, do I address that statement or do I just let it go? So I'll just say this, that if your kids make a certain amount of investment income, they do have to file tax returns. Yes, your kids, doesn't matter how old they are, if they make a certain amount. But like you said, it's a whole separate conversation. And I hope whoever was driving and learning did not just like swerve on the It's like, oh shit, my kid plays video games, so they're gonna have to pay taxes.
Oh my God, it's true. Yep. You're gonna get a huge like tax write-up from this 9-year-old. Like
exactly. All right. So if you bought, Carolina says actually just
Carolina's safe.
Good job. All right. So if you bought or created an NFT, and this is really important, I made sure to kind of explicitly divide the two, right? So there's buying and there's creating, because I know there may be a lot of creators out there as well. And the reason I differentiate between the two is because there are different tax implications, which we'll get to when we talk about the disposition. But similar to stock, virtual currency that we just talked, cryptocurrency that we just talked about, NFT is the same thing. When you buy it, it is a digital asset. It seems like everybody knows what an NFT is. Do you want to kind of just, because I was just learning about it the other day. Do you want to touch on a little bit of the NFT and how it differs from cryptocurrency? Do we assume
that's a great point? Actually, it's so funny. I skip over this because I'm just
like so in the zone that
every day. So an NFT is ownership of a digital asset. It's a digital contract, right? So it means that you basically own a URL that points to an image. And this is when people say like, we're buying JPEGs, like we're actually buying a URL that has a JPEG or an image on it. So yeah, purchasing an NFT means using oftentimes cryptocurrency, sometimes credit cards, to buy that digital asset, that digital contract.
Right. And we're hearing a lot of people in like the entertainment, music and artists and, images and stuff. I ran across, I don't remember if you sent it to me or it just came up because, your phones listen to you, right? So talk about NFTs and all of a sudden this article comes up that Picasso's descendants are saying that he had some artwork that nobody ever knew. So it turned into it was a whole thing. I'm like, really? I mean, he's not here to tell us if that's true or not. But anyways, I digress. So it is a digital asset, right? And so similar to crypto, when you buy it as the property, it's not, there's no taxable event in that thing. So whether you buy it or create it, there's no taxable event at that point. But the reason why I differentiate between bought and create, because that affects what your basis is. So if we go to, your basis when you dispose of. So if we go to the next slide, if you sold that NFT, okay, so if you sold that
long
NFT,
story short, if you buy an NFT, you're fine. Like you're the same thing though, you're recording, right? The date that you made it, how much in the cryptocurrency, and then the US dollar value of that. And this side note, there is a report in OpenSea, which is a marketplace that a high percentage and volume of transactions occur on, that you can download this report. But still, I think in the same way, Web3 decentralization, it's like self-sovereignty, do your own tracking, do your own research on that. But no taxable event at the purchasing moment of the NFT. Right. Now,
you sold it, you disposed of it. Okay, so if you bought the NFT, it's more than likely going to be a capital asset, meaning when you sell it, now you may be subject to capital gains, or capital loss, right? Depending on if it increased in value or decrease in value when you sold it. Now, what happened if you created it? If you created it, then it's now an ordinary asset. And when you sell it for whatever price, because when you created, there was understanding that there may be some costs associated with, like, the platform which you use or whatever the case may be. But when you think about when you create anything, there's no monetary exchange that you're doing right now to create an asset. Think about a painter, right? Yeah, he pays for like the paintbrush, the paint and all stuff, but this actual creation, right? Did you guys like that? And if are there any painters out there were like, yeah, she doesn't know how to paint. I don't know if I did the wrist stroking right and all stuff. But anyways, there's no exchange. I'm not paying to create this thing. So there's almost like zero basis, but there is obviously expenses related to creating, which you can write off differently, right? But then when you think about it, whatever you sell it for, you report the sales proceeds as income. And that would be subject to ordinary income tax rate. So you would have to report it as the way you would transact in any other business activity. So you receive money for something that you created or built, whatever, and then that becomes income tax at your regular tax rate. Okay, I see a question here about gifting. That is a whole separate thing. So whoever that was, if you could just remember to ask that again at the end, or remember that question at the end, we'll talk about it. But
so going back to this, just to make sure we're clarifying key points on this, if you're the creator and you sell the NFT, this is income and taxable income versus we've been talking about currency and NFTs as property. Up until now, it's sort of in that category. But when you are the creator and you are minting the NFT as under your account in your collection, and then you sell it, that is actually treated as income, correct?
Correct. Now the person buying it, now they become the investor. It becomes a capital asset for them, right? So just you got to keep in mind of what role you play in the transaction, right?
Right. If I sold an NFT that I did not create, and I sold it in under a year, right? So I did not hold that asset for a year,
more than a year,
for a year. Then I am reporting that from the moment I bought it to the moment I sold it as a capital gain or a capital loss.
Okay, so great point. And about the whole period, right? And so this is why it's so important when I said at the beginning that you track the dates in which you transacted, right? Because when you think about a capital asset, so up until now, we've been saying, either capital gains tax rate or, capital tax rates or ordinary tax rate. Ordinary tax rate just means your regular tax. Think of your tax bracket, right? Tax bracket you're in based on your income. That's your ordinary tax rate. Capital gains tax rate is generally speaking lower than your ordinary tax rate, right? It can be anywhere from 0 to 20%, whereas your ordinary tax rate can be anywhere from 0 to 37.7, right? 37. Don't get me quoted. And I know as a CPA I should know this, but at the time I'm doing the tax return, I figure it out. But
right, you just look at the chart and
Yeah, I just look at the chart, right? Whatever I gotta do, right? But it's like 37.7 now. It used to be like 39.6 at one point. So 37.5 or 37.7. So that so ordinary tax rate can go that high, whereas capital gains tax rate is more favorable, again, because the government's trying to incentivize people to invest. Okay, so for it to qualify for that favorable tax rate, for like favorable capital gains tax rate, you must have held that asset for more than a year. So for 12 months or more. If you held anything for less than 12 months, it's still a capital asset, but your capital tax rate now is equivalent to your ordinary tax rate. So that's why it's important to know the dates. That's why you hear a lot of financial advisors or whatever say buy and hold. They need to hold for at least a year so you can get the more favorable tax rate. But in the event that you have to sell short term for whatever reason, hey, things skyrocketed, you think they're going to go down soon, so you want to get out while you can, make your money, right? Make your money. And so, understanding that if you hold it for less than 12 months, it is going to be a higher, it's going to be, generally speaking, going to be a higher tax rate than if you held it for more than 12 months. So very good point, Michelle. And that applies again to the person who bought the NFT. So you're the investor, not the creator, because the creator, again, is just the ordinary tax rate. Okay, everybody good?
I think there was a question here. I think this is a good one. Also, hi, Vriti. This is around the gain being converted to fiat, right? So if we take that, so I sold my NFT, but I kept it in Ethereum. I sold it to someone else using Ethereum. So does this apply for the crypto, or when I'm going to take that Ethereum and convert that Ethereum to US dollars back into my bank account? Like which moment is taxable, or are they both?
So I knew that we're going to go into these details. So I like to just kind of pull people back, right? And just remember the fundamental concept, right? Purchase, just remembering to separate the transactions, understanding the flow of the transactions, right? So buying an asset, for investment purposes, no taxable event. Disposing of it, gifting, selling, I was gonna say throwing it out, but I don't know how you throw things out in a digital environment, but whatever. I mean, but disposing of it, you're getting rid of it, that becomes your taxable event, right? So just, kind of breaking up your transaction. So even though these platforms make it very easy by a click of a button, when you understand what it is that you're doing, it becomes a little easier. And again, that's why you have the professionals to help you, divvy it up. But once you make it a habit to track the activity happening, right? Just, hey, look, I bought this many for this much on this date, boom. I sold this many on this date for this much, boom. And then it's just a matter of, all right, which ones did you sell? When did you sell? What did you buy? What was the value at the time? And that should kind of.
And I think this is helpful. So so far we've talked about two parts of this process. The additional layer now, this is a really good question, is converting that currency back to US dollars, right? So now I sold this, made 2 ETH on it. And now what's the difference between if I keep that ETH as ETH, as the cryptocurrency, or if I put that back into fiat, into US dollars, because I need to buy something on Amazon and they don't take
You need to
cryptocurrency.
come out of the meta universe, the
Yeah.
metaverse, and actually buy things in the real world. Okay,
Yes.
got it. So, I mean, think about it. So, at what point did you dispose of the currency? Right, when you converted it back to US dollars, so now you dispose of the currency. And again, I tie it back to comparing it to stock, right? So you have stock in this world, in this digital world or whatever, and then you convert it back to US by selling it, and you get so just think about that. So I think what the to conceptualize is that we're saying virtual currency, which it is, right? Because we could use it to buy stuff, but also think of it as an asset, and it's just the value fluctuates, right? Because at any point you can tell this is the US dollar value of it. So when you think about it that way as an asset, and you think about the dollar value, that will help you determine what your basis and your gains and things are.
Great. So it's taxed the same as above that we talked about, because it's that same process of disposing of the digital currency back to fiat. So again, we're just tracking, okay, so this is the basis word, right? Of what it was when I bought it, and then what it was when I exchange it back to fiat.
Right.
Okay, I love it. All right. So I think those were the main topics we wanted to cover. We've got a question around, LLCs. Then, so, we've been talking mostly around preparing taxes as an individual. I don't know if we want to jump into thinking about this as a business entity, or if we want to talk through the resources piece first. What do you think, Lydia?
So I think we should talk about the resources, and here's why. As far as business activity, I don't know what the general audience is, but there are so many implications of it actually being a business, because that could really, really change the nature of everything. And keeping in mind that this is a 101, maybe we'll have like a 201 or 102, whatever the next step would be about using it as a business asset, because I think that is kind of important. That is important to know, but I think the vast majority of people are still kind of investing in doing these things at an individual level, because there are slight implications and things, and I think we can go down a rabbit hole very, very quickly, and I don't want to lose too many of your audience or overwhelm them, but I'm happy to do another one of these. So in terms of resources for preparing your taxes, keeping in mind that what we do this year may very well change next year, because IRS hopefully will still be giving guidance and providing more law, things that are in the code around virtual currency. So some of the resources, most platforms, I know Coinbase will have reports that will show you your activity and actual tax reports. So similar to stock, you get a 1099 B showing, investment transactions. And it will tell you what's short term, what's long term, what the gain or the losses were. And then worst case, if your platform does not have that, then as we mentioned at the beginning, to track that, even if they don't have the formal tax document, they may have transaction reports. So, downloading those and comparing it to your own records as well, right? That's one of the things that I think people kind of fail to do or take for granted, is that you should also be comparing to your own records, your bank records, show money coming in and coming out, to make sure that it makes sense. And then also keep in mind that some of the fees will offset your basis or offset the gain or loss of there's a fee associated with the transaction, to track those as well, and make sure you incorporate those to either increase your basis or decrease the sales proceeds from the exchange of the cryptocurrency. So those are I think some basic information. Again, I'll reiterate, keeping the dates, the amount that you purchase them for, the quantity that you purchase, when you sell them, the date that you sold them, the quantity that you sold, and how much you sold it for, and the value when you sold it. So, and that would help you tremendously with being able to prepare your tax returns.
Awesome. Yeah, and I think, we do have, I know your point about the 201, so I want to be thoughtful about that, but I think we've got a great group of folks who are with us so far in terms of understanding this. The question of it between my individual taxes versus an LLC. Is there something you can share with us at least? You know, Ivan wrote in here, power to the people, profit to the people. I like it, Ivan. He's saying, you know, as an individual, paying that 20 to 37% when an LLC is maybe 3 to 6%. So could you just at least talk about like what an LLC as an entity and what the like taxes are for LLCs? And then, you know, we can compare that, I think, to everything that you've already shared.
So again, keeping it high level because I feel like it could go down a rabbit hole. And like I said, my information will be at the end. So if anybody wants to kind of have like a formal consultation, we definitely can. So when you think about an LLC or having an entity, then I'm like so nervous about going into this rabbit hole. So it depends on like the nature of your LLC. So if your LLC is holding it as an investment or capital asset, then it's going to be pretty similar to the conversations that we've been having, right? But then if it's actual, like your business is like, that's the nature of your business. So let's say I'm a CPA firm, right? So let's say, obviously I do business advisory work. I do you know, taxes for certain individuals or businesses and stuff, but also my portfolio may include cryptocurrency, right? So that would be treated similarly to how we've been talking. But let's say I started an LLC for the sole purpose of transacting these investments, then we open up this world of like, okay, does it become subject to ordinary taxes versus capital, right? And you know, so different tax rates and stuff like that. So again, it could get very, very tricky. And so there would be differences depending on the nature of the business and the intent or the purpose of these transactions. So
right. I think that is
then LLC
one-on-one with you, because I think there are a lot of folks in here who their businesses would be for their businesses are in Web3, right? So their entire sort of purpose of the LLC is around that versus, you know, I'm doing my, you know, I don't know, educational or CPA, whatever business it is, and I have, you know, some digital assets. This would be, you know, the entirety of a business is for that purpose. So yeah, it sounds like then that is really a more tailored tax approach. That is a good
and then it becomes like, are you guys the one created? Because now in essence, so think about like a manufacturing company, right? So, you know, you have this business and you're creating these assets, and now it becomes your inventory. It's not a capital asset, it becomes your inventory. So it's treated differently, right? And so I see the question here from Ivan, LLC as a business of NFT art creation. So you're creating the art. And now you're a creator again. So it's no longer a capital asset. It's an ordinary asset. It's inventory and stuff. Now the person you sell it to, that depends on who they are. If it's an individual or an art collector, you know. So yeah. So you see how it can become very, very involved and very, very tricky and different. So, but I hope that kind of helped with kind of differentiating the two depending on like the purpose or the intent of the asset. So. I think an example, I remember, you know, taxes, understanding the different implications as a business. So think of a refrigerator, like a piece of equipment, right? And a refrigerator at BrandsMart is inventory because it's being sold to somebody else. A refrigerator in a restaurant is a piece of equipment, right? And so it's treated differently. You could depreciate it and stuff like that. So again, it depends on the purpose and the nature of the asset that would determine how you treat it and stuff like that. So it can be very, very involved, but
like it's,
you know,
matrix. It's not red pill, you know, blue pill matrix. Like it's like a decision matrix, right? Are you
right? If I do this, then this. Exactly. Yeah.
So,
and then again, I take a step back to say, and I use the refrigerator because we have guidance for that. We have like, we know it's a piece of asset for the business. You know, like I said, there was a bill, presented as recently as last week that is imploring the government to provide more, you know, guidance and I'm more law, right, are the requirements and stuff. So is definitely something to think about. And Michelle, we talked about this a little yesterday, so I'll bring it up again, that, we had a scenario where a couple, we could talk about that, the whole staking and stuff like that, right? So when you stake and earn income on it, whatever, like there was a couple, I forgot what state they were in, but they paid, a significant amount of taxes on the staking or the amount. And then the IRS, they challenged it, and the IRS came back and said, okay, right, we'll refund you, fine, right? Because they argued that it wasn't earned income, it was the creation of an additional asset, right? And so that couple won. So first of all, whoa, right? So many people are like, how do you beat the IRS? But they did, and the IRS said you can take the money back. And what did they do? Did they took the money and said, woo, I won, let me keep it going? Nope, that would have been a great thing, and I for one part would have done the same thing. But what they did is, in fact, they challenged it. They said, no, we don't want to just get this money back, we want more clarification. And I was talking to Michelle about this, again, conversations, that I thought that was a great idea, that they did that they challenged and said, no, we need more legislation, we need an actual quote, what is the requirement? And here's why. Even though the IRS refunds, gave them that money back and said, okay, yeah, you're right, it was a creation, there's no tax on creating an asset. What happens a few years later when the IRS actually codifies, whatever the word is, and actually makes a rule and say, no, it is taxable? Then if it's within 3 years, the IRS can go back to them and say, no, give us that money back plus interest, right? So it's like, okay, no, tell us what the rule is so that we know moving forward, this is what we're going to do moving forward. And this is what the general population, so taxpayers are going to be subject to. So all that to say that, it's the IRS is being urged and compelled to come with more regulation. Because if you're going to regulate this, right, and tell people that they have to pay taxes, well, you need to tell us how much, you need to tell us how to do it. And so right now it's just guidance, and I use the term guidance based on what other properties, like, stock and stuff. And that's why I've been using that as an analogy, because that's pretty much the guidance we've been given so far. But now we have all these new things like staking and mining and tokenizing. Okay, what does all that mean? And so, I am, going to be monitoring that now that I'm into this metaverse world, tracking this and understanding what the tax implications are. But I would say when I work with my clients, I'm going to do what works out for my client, right? And what benefits my clients, but also understand, hey, worst case, if IRS comes back and says, this is how we're supposed to do it, here's what your exposure is like, but let's do what benefits you. That would be my approach.
Love it. Okay, great. So we have about 10 minutes left. It's a lot of friends here in this group. Mm-hmm. And so I think our host, we can let people come off of mute if they have a question that they want to ask live. I really quick want to answer Monica's question as people are getting ready to ask whatever question they might have. So she said she bought crypto on Coinbase, transferred it to MetaMask, bought an NFT, and she still has it. So in that, if I did my notes right, mm-hmm. You have not, converted that asset. So there's no taxable event around the NFT. Taxable Correct. Event is the conversion of the crypto to the NFT, right?
Michelle, I'm so proud. You don't even need me here. I'm off. I'm getting off. I'm logging off. You can handle the Q&A.
This is basic.
No insult to anyone who has not grasped it. It's just she's a superstar. That's all.
Briti question is much more involved, I think, with the DAO and if she's paying employees with crypto and transferring to fiat. So I feel like that's again, like considering all the elements of the LLC, that might be a chat with Lydia afterwards. So if anyone is on that wants to ask a question, you can unmute and say hi to us.
Mm-hmm. And I see Carrie mentioned there are so many government bodies regulating crypto. Yeah, definitely need clarification. So there are, and it's just so ironic that, again, crypto was created for the purpose of not being regulated, and now we have all these entities regulating. So you have the IRS, you have DOJ looking at like FinCEN, like financial crimes unit, right? So even if you're not really selling or disposing, but like, okay, if you have crypto overseas and international and the dollar amounts, and if you transact over a certain amount, do you have a reporting requirement? Even if there's no tax requirement, if there's a reporting. So yeah, it's really, there's a lot of guidance that we definitely still need, and a lot of people are urging. And so we're having conversations like these to kind of share the information that is out there, and then, and filling in the gaps of what's missing based on what we do have until we get further clarification.
So Jose has his hand up. I don't know if we want to let him unmute.
Hello, can you guys hear me?
Yes.
So Michelle, Lydia, thank you so much for the space. All this information was very useful.
Awesome.
I wanted to ask, I'm not sure if it's been answered, but if I own an NFT, convert that and sell it to ETH and then convert that to fiat, is that now double taxed?
Okay, so it sounds like double taxation, but remember, so now the tax and stuff that you pay on one transaction, right? Let's say the selling of, I lost my train of thought with what is it? You took ETH and then you sold an NFT. So the capital gains tax that you're paying on the transfer of the crypto, right? You're paying that tax, but now your basis is higher in the NFT. So you're not necessarily paying the same tax on the same dollar, right? Because now your basis in an NFT becomes larger. And so you're just paying taxes on any additional gain on the NFT. Does that make sense?
Right. And if you do the same day, I guess you're not really paying too much capital gain. Makes sense.
Correct. Right. Because the value probably wouldn't change that much.
Can you just touch up a little bit on wash sales? I think from what I hear, that's something that could be used in favor of any crypto, because from what I understand, it's not been regulated yet.
Yeah. So wash sales so it's okay. So when we talk about wash sales, relates to like your stock and stuff. And so again, if we're using that analogy or using stock as a reference of how we treat the crypto, really great question. So are you in accounting? Like, how did you know? Not a lot of people know about wash sales. Okay. So what in the stock environment, when you exchange one stock for another, like equal within a certain amount of time, and you incur a loss. Okay, let me backtrack. Usually when you have a loss, you can deduct the loss, right? Or the loss will offset any other income that you have or other gains, right? Now that law, and obviously that can help you with your taxes, right? That can help with reducing your tax liability. However, if you sell something and get a loss, but then you turn around and buy the same asset or something very similar within a certain amount of days. I don't remember if it's 30 or 60 days, but if you turn around and buy something else, then the IRS says, well, you can't take that loss because you essentially just rebought the same thing, which then you're kind of like double dipping, if that makes sense. So, I can't say with certainty that, like I said, there's no legislation around cryptocurrency, but again, if they are saying that it's treated like property, like stock and stuff, I would imagine the same things, the same rule would apply, that if there's a loss, it would be essentially washed away. Did that answer your question, Jose? Yes, thank you. Okay, he's muted, but thank you for saying. Great question, Jose.
That was great. Yeah, apparently there's a lot of wash sales happening between different wallets to a bit manipulate, prices. That's what Carrie's sharing, and I know I've heard that kind of back and forth.
Nicole, hi Nicole. I know her. Nicole has a question. Do we want to?
Yeah, she has to mute. There we go.
Hi.
So I stepped out for a second. Excuse me if this question was asked, and it was kind of brought up a little earlier. We decided we were not going to divulge and go into it. But I've purchased some NFTs. One of them specifically is creeps. Love creeps.
Said no woman ever. No, I'm kidding.
Right? With the Z, right?
Like creeps with the Z.
They're better.
If anybody heard that out of context.
But Michelle understands. She knows. So I specifically, I purchased a couple. One specifically, I wanted to be for my son. He's 12. And so I don't see myself selling it before he's at least 13. So I think there's some crypto platforms that allow 13-year-olds to have their own accounts. But since I purchased it with my account, can I just transfer it to him and then sell it under his account? So he's the one that has the tax event? Or could I sell it and then, like, is there another way to avoid me being taxed for something that I intentionally purchased for him?
Okay, so we go, that sounds like gifting.
Okay.
And yeah, right. So, and I think I saw that in like one of the comments and stuff. So there are different rules for gifting. So you definitely can still gift it to him. And there may be a reporting requirement. And that's the tricky one because we have to break it up. He would essentially, you are able to transfer when you give something and everyone's alive. So this is not a scenario where someone dies and it's transferred. So because there's separate implications. And I don't know if anyone's listening, they're like, oh my God, how does she keep this all in her head? Exactly. So if you're gifting while you're alive, which is different from, something being inherited through death. Then what would happen is your basis, what you purchase it for essentially transfers over to him. Now, that said, there is something called the, oh gosh, and I'm trying to think if they did away with it, the kitty tax. Because the same way you thought, a lot of people started doing that to kind of avoid paying taxes at their own, tax rate and transferring to their kids. And then their kids will then pay, obviously may or may not have any taxable implications. So there's something called the kitty tax that even, so to answer your question, yes, you can transfer it to him. What you paid for it, your quote unquote basis will now be his basis. But there may be either a gift tax implication, meaning you have to report it even if there's no tax on it. But then also when he disposes it, there still may be a requirement for you to report his gain on your tax return. Now, there were some changes with that in 2017 under the old administration, where some things changed with the kitty tax. And I'm trying to remember off the top of my head, but it's you probably wouldn't be able to avoid all the taxes altogether because there's something the kitty tax.
Okay, I think we have time for one more question. Eva, I believe you can unmute. I click ask to unmute, so you should be all set. So we'll ask that. And then, yeah, I think a lot of this, what we are coming away with is, it's not so simple, to be able to have a formula of like, here's all the ways that each of us can leave here and be prepared, right? It is a bit case by case. Some of these things are common and we all have done them, and some of them are nuanced.
Very specific, yes. Yeah.
Hi, everyone. Can you hear me?
Yes.
Great. Hi, everyone. Thanks again, Michelle and Lydia, for putting this together. It's super helpful.
Awesome.
So I have a question because we're sort of going into uncharted territory here. We have partnered with a group that has developed an NFT through like a subsidiary of Citicoin. But the NFT is to benefit the Foundation for New Education Initiatives, FINI, which is the school board's foundation, which Michelle, I know you're familiar with. So the question is, as of right now, both the city of Miami and us are in sort of the same position where we cannot have a cryptocurrency or like our own crypto wallet. So this entity has to essentially give us the donation from their LLC. But the question is like, how does that taxation work, since they essentially hold the crypto wallet for the NFT, they hold the sales, they get the money, and then the money has to be converted, I guess, to their through their LLC's crypto wallet, and then give us a cash donation, because we're not, the government, and we're a direct support organization for the district, which are governed by separate rules, can't quite hold a crypto wallet yet.
Right. Okay.
So how does that work for, the LLC, and also, well, for us, obviously there's no taxes, but how does that work for the LLC? And is there any way of shielding them from the capital gains tax?
Okay, so the way it works when you're
Answer
gifting,
this in 30 seconds. Like you are really the all-star, but we'll try to do.
right. So I'll just try and give you the concept and use stock as an example. So generally speaking, because people make stock donations all the time to nonprofits, and so if somebody just converts, is able to transfer the stock over to the nonprofit, and then a nonprofit now holds that stock and they can dispose of it or keep it however long they want, they would essentially, the entity giving the stock will be able to take a deduction based on the fair market value of the stock at that time. And then the nonprofit would then report the fair market value as a donation. Now, in this area where they sell the stock first, well, then that's on them. Unfortunately, they would have to pay either the capital gains tax, or if there's a loss, they can take the loss. And then once it becomes US dollars, and it's just like any other donation to the nonprofit. So, you know, if there is no way, and I can't speak to that of whether nonprofits can hold, I don't know if this is part of their charter or their bylaws that they cannot hold crypto wallet, but if they can, I would say just transfer the asset and let the nonprofit, if it's increased in value, because right, if it's increased in value, they get a higher deduction and you can donate to the nonprofit. If it decreased in value, then actually may benefit them to sell it, take the loss, and then give the cash to the nonprofit. So that's keeping it kind of high level without actually even having to dive into what the LLC does or who they are. And stuff. And we're right at the 1 p.m. mark.
I know. Eva, there's actually a gala for the Superintendent's Foundation this weekend. Eva, I think you should invite Lydia to come, and then you could talk all of these details in person.
I wish, but I'm in the beautiful island of Barbados, so that's.
Well, thank you all, and I know there's still more burning questions, but we do have to run. And I think, you know, this did the thing that we thought it would do. It's like it covers the basics, and it opens up the can of worms that each of us as individuals, each of us as business owners, each of us
creators,
so all of these, as nonprofits, whatever it is, like we have to be in the driver's seat, and we need an expert who we work with who prepares our taxes and, you know, helps us with all of these nuances. So that is, you know, our homework, to individually be prepared for that, and then to find someone to partner up with, to make sure that we are maximizing our you know, tax
strategies,
returns, hopefully. And our tax strategy come April.
So I don't know who Jay was, but I just saw a comment that like made me smile, because that's something I pride myself. He said, "Thank you for making it non-CPA for helping us understand." And I take so much pride in being able to speak in layman's terms so people can actually understand. So thank you so much for having me. This was fun. Welcome to the metaverse, everyone.
Thank you all for coming. And one last thing, I want to offer our group, which is the Web3 Equity, our Women in Web3 group, which many folks who are in here are part of. But if you are not a part of that, that is really to onboard more women into Web3 and make sure that we are participating in the equity and getting the highest, you know, returns that we can. And so I just shared here the link. If anyone wants to join that chat, we share a lot of resources there. We ask each other questions. There are no stupid questions in our chat. And we have a really wonderful community that is growing as we are, you know, we are diving into this Web3 space, and we want to be educated, and we want to, you know, make the most informed moves. And so that's a great resource I offer to you all.
And kudos to you, Michelle, and your team for providing that equity and having this forum for women to get into the tech world, because it is otherwise a male dominated thing. And we love our men, but we are just looking to be involved as well. So really kudos to you. I'm so excited and so proud of you. You should be really proud of yourself. And I'm very happy that you invited me to be part of this.
Thank you all. And thank you all for attending. You guys are great. This will be recorded and we will share in the upcoming days, and definitely follow up with Lydia or I from here. So thanks again, Lydia, for your time.
Bye.
Bye.